Rocket Lab just put 8 satellites into orbit, but the launch is not the headline investors should care about. The real story is that Rocket Lab built the hardware, helped deliver it to orbit, and now sits inside the operating network that will sell direct-to-device connectivity and IoT service. Those 8 spacecraft are the first batch of 17 platforms Rocket Lab built for MDA Space under our $143 million deal. Every satellite has been contacted, everyone is reporting power, and commissioning has started for Globalstar's existing constellation. That changes the question around RKLB. This is no longer only a launch company trying to sell more Electron flights. It is a space systems business trying to own more of the value chain between a customer's contract and a working network. Nothing in this video is financial advice. This is for educational and entertainment purposes only. The finance setup is unusually clear. Rocket Lab's latest quarter produced record revenue of $234 million, up 62% year over year. Backlog reached $2.36 billion, up 137% year over year, and the company said more than $1 billion of new launch and space systems contracts had been signed in the quarter and the period after it. The new satellite mission gives that backlog a physical proof point. A signed contract is a promise on paper. 8 healthy satellites in orbit are a working asset that has moved into commissioning, and it arrives while the stock is still being priced like a speculative launch proxy. The finance snapshot available before the market opened showed RKLB at $80.25 and ASTS at $70.98. The comparison matters because both names sit in the space investing conversation, but they monetize different stages. Rocket Lab sells access and hardware today. AST SpaceMobile is still proving the service layer at scale. On August 15th, the first 8 platforms launched from Cape Canaveral. Rocket Lab's official release says they are Lightning-derived spacecraft built for MDA Space, which is the prime contractor replenishing Globalstar's constellation. Globalstar's network supports direct-to-device communications and IoT applications from orbit. The important detail is the customer chain. Rocket Lab is not selling a consumer phone plan in this mission. It is supplying the spacecraft platform that becomes part of somebody else's communications network. That distinction is what turns the mission into an investment lesson. Space hardware is often described as a one-time sale, but networks create follow-on demand. More satellites mean more manufacturing, integration, launch, commissioning, maintenance, and eventually upgrades. The revenue flywheel is not one rocket going up. It is a customer returning because the network keeps operating. Rocket Lab is already showing the operating scale behind that thesis. Management said Electron and HASTE had completed 13 launches this year, with 100% mission success at the latest earnings call, and the company's launch backlog had grown past 90 missions. More than $437 million of launch bookings were signed across Electron, HASTE, and Neutron during Q2 and after quarter end. But the more important mix is in space systems. Rocket Lab reported $899.5 million of space systems revenue in Q2 versus $44.6 million from launch services. That is not a clean recurring revenue model yet, but it does show why the company wants investors to see it as more than a rocket operator. The 8-satellite mission also connects to the company's larger defense strategy.
Rocket Lab recently announced a $397 million Flatellite award, and management said Neutron is the planned launch vehicle for that program. The business is stacking spacecraft, payloads, launch and orbit operations into one pitch to government customers. That vertical integration is the bull case. If Rocket Lab can build the satellite, launch it, and support the mission, it can capture more economics and reduce dependence on outside suppliers. It can also make the customer relationship harder to displace. Start with the backlog. At $2.36 billion, it is more than 4 times the company's quarterly revenue run rate. Management said approximately 45.5% of the current backlog should convert to revenue within the next 12 months. That does not mean 45.5% becomes free cash flow. It means the first question is not whether demand exists, it is how smoothly Rocket Lab can manufacture, launch, and recognize that demand. The second opportunity is contract quality. Large awards create visibility, but they also create execution risk. The $143 million MDA Space program gives Rocket Lab a real satellite production reference. The $397 million Flatellite award could become a much bigger proof point if the company meets delivery and launch milestones. The third opportunity is launch cadence. Electron is already flying and HASTE is adding a defense-oriented suborbital product. Management says customers are booking in batches, including an IQPS agreement that brings its total Rocket Lab launches to 18. Bulk bookings are valuable because they reduce the risk of living contract to contract. The fourth opportunity is Neutron. The company is targeting delivery of the rocket to its launch pad in Q4 2026. It has completed more than 400 Archimedes engine hot fires, and it is already producing first flight engines. A successful Neutron path would expand Rocket Lab into medium-lift missions, where the contract sizes and customer set are larger. But Neutron is also where the valuation gets tested. Management said the year-end launch window is narrowing. Delivery to the pad is not the same thing as flight. A first flight schedule can slip even when hardware is progressing, and the market may punish the stock for that gap. Analyst ratings can tell you how expectations are positioned, but they cannot remove first flight risk. The real trade is between current execution on Electron and satellites versus future value assigned to a rocket that has not yet flown. Rocket Lab's cash profile makes that trade more important. Management reported $84.1 million of GAAP operating cash use in Q2 and $110.1 million of non-GAAP free cash flow use. Liquidity was roughly $2.4 billion at quarter end, helped by $1.08 billion raised through an at-the-market equity program that was later terminated. That liquidity buys time, but it also tells you what kind of company this is. Rocket Lab is investing ahead of demand, especially in Neutron, testing infrastructure, and production scale. Investors are underwriting a future platform, not just collecting current profits. Risk number one is schedule. The 8 MDA-built satellites are a strong operational data point, but one successful deployment does not prove every future program will run on time. Neutron remains the largest execution variable in the story. Risk number two is cash conversion. Backlog is not revenue and revenue is not free cash flow. Rocket Lab's growing systems business can absorb working capital, while Neutron can demand more testing, tooling, and infrastructure before producing meaningful launch revenue.
Risk number 3 is customer and program concentration. Government contracts can be large, but they are milestone-driven and subject to budgets, procurement timing, and technical acceptance. Commercial constellation demand can be powerful, but customers also face financing and deployment risk. Risk number 4 is dilution and capital allocation. The $1.08 billion equity raise strengthens the balance sheet, but it also increased the share count. That money can create value if it funds durable contracts, production, and strategic acquisitions. It can destroy value if the company keeps expanding faster than the economics mature. Finally, do not confuse a good mission with a cheap stock. The finance snapshot showed a market capitalization near $46.5 billion. That is a large expectation embedded in a company still reporting losses and funding a major new vehicle. The stock can work, but the margin for execution error is not unlimited. The bigger picture is a change in what space investors should count. Launches still matter, but the durable value may sit in the network that a launch enables. A satellite platform that gets commissioned can lead to replenishment. A defense contract can lead to follow-on missions. A proven launch vehicle can make a spacecraft manufacturing relationship more valuable. Rocket Lab is trying to connect those stages. Electron provides access, Space Systems provides hardware, Neutron is the option on medium lift. The MDA mission is evidence that customers are already paying for the middle of that stack. For the investor, the checklist is short. Watch the next satellite milestones. Watch how much backlog converts in the next 2 quarters. Watch operating cash use as Neutron spending rises. And watch whether the Q4 pad delivery target becomes a real flight campaign rather than another date on a slide. The bullish view is that Rocket Lab is building a revenue flywheel. Manufacture the spacecraft, launch the mission, support the network, and win the next contract. The bearish view is that each step requires more capital, and the hardest product in the stack has not flown. The 8 satellites in orbit do not settle that debate. They raise the quality of the evidence. So here's the question for the comments. Does Rocket Lab's next dollar of value come from another launch, another spacecraft contract, or the first credible Neutron flight campaign? The answer will tell us whether this is still a launch stock or the early version of a full-stack space infrastructure company. Nothing in this video is financial advice. This is for educational and entertainment purposes only.